Hello everyone, you're welcome to my channel Promotion for Sure. In this video, we are going to talk about Treasury Management, which is Module C of Bank Financial Management of CAIIB course. In this video, we will be covering the entire module in a summary format covering all the important points which you need to remember and know for clearing this module and this paper. So if you like this video, you can press the like button, subscribe to my channel and share it on social media. Help us to spread education in this beautiful world. Now, if you have clicked to watch this video, be rest assured you have reached a channel that will give you a treasure of knowledge. That's a promise. So please subscribe and become a lifetime learner. Thanks for subscribing our channel. Now let's talk about treasury management. Now in this module, in this video lecture, you'll see introduction to treasury management, treasury products, funding and regulatory aspects of treasury management, treasury risk management, derivative products, and treasury and asset liability management. Now, where did the concept of treasury came? Now, originally engaged as service center, treasury was originally engaged as a service center only in daily cash management, preemptive reserve management, restrictive deployment of surplus fund. However, now it is seen as a profit center. So from a service center, it is now a profit center. Now, how it has changed with active operations in all the markets in the country and abroad except commodities market. Now, it continues to deal in only short-term market excepting in except in the case of SLR investment and capital market products. Now, if you talk about integrated treasury, what is integrated treasury? Now, it means merger of both domestic and foreign markets, meaning two-way movement of funds depending upon the changing market scenarios and emerging opportunities. We all know that we live in a globalized world wherein the world is a village. This means that if you want to do a business, it is possible not only in India but any part of the world. Similarly, both domestic and foreign markets have also merged together and formed a unified market, and this is called integrated treasury. So, forex money and equity market, it's being possible due to liberalized environment. As markets are integrated, so are the risk. Derivatives are used extensively for risk management. So, when we talk about risk management, the first thing that comes to your mind and should come to your mind is derivatives. We are going to study about it later. Let's see what are the enabling environments. How is it possible for uh, the treasury to have reached such an important height, such an important level where it is giving profit from service? It has become a profit center for the banks. How? Because of the enabling environment. Creation of Clearing Corporation of India, establishment of NSDL, large number of non-banking financial companies and mutual funds, private insurance providers, foreign institutional investors and foreign direct investment, availability of derivative products in money, equity and forex markets for interest and price risk hedging. Now these are the reasons why treasury has become a profit center now. Now, what is Treasury role in profit maximization? How Treasury is increasing the profit of the companies, banks, and financial institutions? It is because the large size deals leading to less operational expenses. So, in Treasury, the more the size of the transaction is, the more profit you're going to make because the operation cost will be less, relatively less uh, risky free markets, need for less capital outlay. You don't need much capital to set up a treasury business. Highly leveraged and with higher return on capital. So the profit is good. Now, what are the sources of treasury profits? Where does the treasury make the profit? From merchants and propriety. Arbitrage in different markets due to time differentials, though negligible. Now, arbitrage means doing business wherein you check the rate from one market to the other. And even if there is a slight increase in the price or decrease in the price, you sell or buy on these markets. So arbitrage is basically playing on the differentials, small differentials, and making profit, both in cash and derivative markets. Okay. Now let's talk about what are the sources of treasury profits in money market. Now shuffling of investment takes place of price changes in investment holding, borrowings and lending in money and repo markets, taking advantage of inherent strength, retailing of government securities. So basically, money markets make money profit for treasury by shuffling the investment, taking advantage of price changes. Now, let's talk about the organization of treasury. This is very important. You need to understand this. There are three offices, which is front office or dealing room, one is middle office, and one is back office. So let's first talk about front office or dealing room. Now, dealers in various segments carrying actual trades. Forex markets, there can be specialists operating in forwards and derivatives, security markets generally in secondary market, and investment desk operating in primary market. So, who are the people who are there in the front office? All the dealers who are carrying out trades. So there are three types of markets which are present, or market players which are present in the front office. Players who are there for forex market, security market, and investment desk. So this is very important. The second important office is back office. Now back office is for verification of deals done and settlement thereof. Accounting, maintenance of nostro, and reporting to regulator is done by back office. Now there's another office called middle office. Now this office manages the risk and adheres to various exposure limits and MIS to the board. This is also very important. So the front office deals with the operations part, back office deals with the verifications and settlement, and mid office deals with the risk management. Now forex treasury products. Now what are different products of forex treasury? First is spot trades, forwards. Now, both for merchants cover operations and proprietary trade for profit. So, it is for both merchants and proprietary. Generally, forward rates are related to interest differentials, but in our country, also on demand and supply. Now, what a currency swap for customers and for funding the proprietary transaction and interest arbitrage. Options and futures, investment surplus in short and long term foreign currency assets, treasury bonds, interbank loans, nostro balances, and also FC loans to domestic customers. Now, what are the instruments of money market through which the treasury makes profit? Call money, notice money, term money, treasury bill, commercial paper, certificate of deposit, repos and reverse repo, and acts as upper band and floor of money market rates. Bill rediscounting. Now, security market products. Now, government securities and other approved securities for SLR compliance, such as market stabilization scheme, corporate debt on non-SLR securities, both medium and long term, rating credit quality determine yields. Now, corporate debts, they are debentures transferable only by registration, bonds transferable by endorsement and delivery, convertible bonds, floating and fixed rate bonds, callable bonds, step up coupon bonds, deep discounting or zero coupon bonds. Now, periods from where repayment is an installment, premium bonds where premium is paid on redemption, collateralized bonds, creation of trustee for managing the affairs and protecting interest of investors in case of debentures. Now, investment in equity market, cap on investment at 20% of the net worth, both in primary and secondary markets as a qualified institutional investor. Private placement requires a research desk. Now, investment from in overseas market, FII investments, ADR, GDR issues of Indian corporates, EEFC fund, foreign currency funds of banks, Borrowing and lending in call money markets subject to ceiling of 100% and 25% of net worth. Preemptory reserve funding aspect, CRR is at 84% now, based on demand and time liabilities on fortnightly basis, minimum 70% on each day. Exempted liabilities include interbank, RBI, ACUC, CIL, capital reserves, ECGC, DIGC settlement claims. SLR investment currently at minimum 9% of net demand and time liabilities. Approved securities include, in addition to Government of India securities, excess cash with branches, state government securities, and other securities as identified by RBI. Now, regulations covering treasury, liquidity adjustment facilities, repos and reverse repo rate, payment and settlement system, negotiated dealing and RTGS, SFMS. Risk in treasury, we have credit, market, and operational risk in every treasury operation. Credit risk in debt, equity, and forex OTC activities. Market risk, liquidity, and interest in all operations. Operational risk is very much present because of wholesale nature of business. Now, if we talk about risk management, there are organization controls, which is dual controls on activities, internal controls, exposure ceiling limits, position limits, deal size limit, open position limit, stop loss limit. Now, risk measurement, there are two ways to measure risk management. In fact, value at risk, it is an estimate of potential loss derived from volatility in the market. Volatility is the standard deviation of price over a chosen period. Now, different methods of calculating VAR, value at risk, correlation using historical data, simulation using various parameters, Monte Carlo simulation using large number of parameters. Now, yield is different from interest. Coupon on a bond depends additionally on bonds and intermittent cash inflows. Coupon payments, it's IRR of the bond. Bond yields, current yield is coupon divided by current price. Yield to maturity is the yield if the bond is held till it matures. Two bonds with the same yield to maturity may have different prices because of frequency of coupons. Duration of a bond is a measure of the time taken to recover the initial investment in present value terms. Duration is the measure of the average time prior to the receipt of payments. Every bond has a component of intermittent coupon payments and repayment at maturity. During the life of the bond, if the market interest rate changes, the bond price will be affected, and also the rate at which these intermittent coupon bonds can be reinvested. Now, duration takes into account the frequency of coupon payments and studies the price movements of a bond. The period can be different for different bonds of the same maturity because of the size of intermittent payments. Duration of a bond where there is no intermittent payment coincides with the tenure of the bond. Duration, it is obtained as a sum of weighted averages of present value of inflows, with weights being the time in the years of respective coupons. Modified duration is duration divided by 1 plus yield. Price variation in percentage terms. Longer the duration, higher is the volatility. Treasurer arrives at the duration of portfolio by adding the durations of each of the member of the portfolio. To protect the portfolio from any interest rate risk, the portfolio is to be held for a period equal to its duration. This process needs frequent shuffling of the members since duration will change as the maturity date approaches. Now, what are some of the derivative products? Over the counter and exchange traded products, forward and options, futures, stocks, currency and interest, swaps, currency, interest rate and basis, price ensuring products, options and price fixing products, others. Now, derivatives are used by market makers, hedgers, speculators, arbitrators, take an opposite position in derivative market to the position in underlying cash market. Now, forwards is OTC contract. Both parties are committed to contract definite delivery. Price fixing in nature, pays off are linear to the underlying existence of credit risk result in counterparty exposure limits. Forward price is equal to spot price plus cost of carry. Now, options, types of rights, call and put, types of by modes of settlement, European and American, types by benefit, at the money, in the money and out of the money. Uses of options are hedge against price risk and also for trading for profit. In the money, at the money and out of the money depends upon whether the strike price is better, equal or worse than the market price of the option. Current price of an option will depend upon the host of factors like underlying asset price and its volatility. strike price, interest rates, time to expiration. All factors have a positive correlation with the strike price except the strike price. Options continue. This is the mathematical formula. Futures are both financial and commodity. Currency futures are similar to forwards. Currency stocks and index futures are hedging instruments against price fluctuations. Interest futures are hedge against interest rate movements, either delivery or back out. Margin requirement, initial margin minus enables the trading of the various high volumes compared to own stakes, variable margin due to daily MTM, and maintenance of margin. Exchange traded currency futures recently introduced as exchange traded product. Banks complying with the following can be clearing members, can trade for themselves and the clients. Exchange traded interest future, hedging investment risk with long position in futures. Now investors risk can fall in market interest rate, which would impact his return on investment. Now when interest rate falls, prices of futures increases. By going long on futures, he or she can take advantage of reduced interest situation in case it happens, which will offset his loss in underlying market. So pricing of future is spot price plus cost of borrowing minus income of the asset is equal to future price. Swaps, it is interest rate, equity, and currency swap. Interest rate swaps can be floating to fixed, floating or to floating on a basis. Coupon swaps. Now, forward rate agreement is currency swaps, only principal, only interest, principal, and interest. Now, RBI guidelines on derivatives, only plain vanilla swaps are permitted. Banks can use them even for profit. US dollar, Indian rupee, and cross currency options are permitted but only for hedging. Specific RBI permission is required to trade in options for profit. Trading positions in derivatives to be MTM on daily basis. Banks can become members of FNO segment to trade and exchange derivatives. Treasury role in ALM, asset liability management. Since Treasury deals in large volumes of fund, it can both mobilize and deploy the funds as per bank's requirement, either domestically or in overseas centers. So asset liability management is basically taking care of the liabilities and asset sides of the balance sheet. For example, you have to make payments in a month to important parties. For that, you need to keep certain amount of funds. So managing this amount of fund so that the payment can be made on time is basically asset liability management. Now, being in constant touch with the marketplace, Treasury can have better estimates of future interest rate movements in the market. Treasury is also engaged in determining the transfer price mechanism. So these are the important points for the exam point of view. So if you have reached the end of this video, be rest assured you have reached a channel that will give you a treasure of knowledge. That's a promise. So please subscribe and become a lifetime learner of a channel. Thank you. Have a great day. Bye bye.